5 beginners mistakes you should avoid before you buy any stock. First, do not chase headlines. Second, you know why you are buying that business. Third, never ignore valuation. Fourth, stop watching stock prices every hour. And most importantly, diversify your portfolio. So starting with the first one, the first beginner mistake is buying because everyone is suddenly talking about the same stock. Mistake 1 is buying only because of a headline. A company announces a new product, the stock suddenly jumps and everyone wants to buy that business. The news may be correct, but the market may have already adjusted the stock price. So before you react, ask whether the news changes the company's long-term revenue, profit, cash flow, or competitive positions. So that gives us the first part of the analysis. Now we can move on to the next question, and that is understand why you are buying that stock. So before you buy a stock, ask yourself, do you understand the business and how they are making that money? So mistake 2 is buying a company without understanding its business. For example, if you buy Apple just because everyone knows about Apple stock, that does not justify the investment thesis. However, if you understand that Apple makes money by selling products and services, so what may drive future growth and the main risk is you understand and expect and how to monitor. When the stock falls, this understanding helps you decide whether the business changed or the price changed. That is one complete piece of research process, and it leads naturally to the next step, that is never ignore valuation. A great company does not automatically becomes a great investment at every price. So you need to understand how. For example, Cisco was a strong and important company during the internet boom, but investors who paid extremely high prices still faced many years of poor stock performance. So always compare price with earning, cash flow, growth, and reasonable future expectations. This point can stand on its own, but it becomes more useful when you connect it with the next part of the analysis, and that is stop watching stock price every hour. Checking a stock price every hour or every day does not make you a better long-term investor, because daily stock movement price can be from different reasons. For example, economic news, interest rate, market sentiment, are short-term trading, and most of that may have little to no connection to the company's long-term performance. So instead of checking the price every hour, create a list of business metrics to review after each earning reports. And you need to keep this idea in mind because the next one is built on this, and that is diversify your portfolio. Even a strong idea can damage your portfolio when the position is too large. So mistake 5 is putting everything into one or few companies only. So a lot of time confidence can feel strongest just before something unexpected can happen. A company may face competition, regulation, fraud, technology changes, or major operational problems. For example, those who invested in Nokia long time before when the stock was at the high, and if their whole money was invested in that, when stock crashed, almost they have lost 90% of that value. Diversification does not remove risk, but it can reduce the damage caused by incorrect decisions. So notice the pattern behind all 5 mistakes. They happen when the decision is driven by excitement, fear, or confidence instead of repeatable use. The solution is not to predict every stock market move. The solution is to slow down and ask the same question every time. So before buying any stock, try to understand the business model, growth driver, financial condition, valuation, main risk, and position size. You may still make mistakes because no process is perfect, but your mistakes are more likely to be controlled and understandable instead of emotional. So these 5 mistakes are chasing headlines, having no or basic understanding about the business, ignoring valuation, watching prices too often, and concentrating too much in one company.